Problem 210. The question states the Moore Corporation has operating income, EBIT, of $750,000. The company's depreciation expense is $200,000. Moore is 100% equity financed and faces a 40% tax rate. What is the company's net income and what is its net cash flow? So we know EBIT 750, depreciation 200,000, and 100% equity finance with a tax liability of 40%. So how do we get down to net income, and more importantly, then how do we get to net cash flow, or what we're getting at is essentially operating cash flow? So what we really need to consider here is when we look at an income statement, what do we start with on the top? Well, the beginning of an income statement is what? It's sales or revenue. Then we back out for our variable cost, our fixed costs, and then we back out for depreciation. And you can also account for amortization there too, but mainly depreciation. And what are we saying there? Well, the firm had asset depreciation of a given amount that's set by the IRS, and that money is removed from the income statement. It doesn't mean the money leaves the bank account, but what it does is it lowers the firm's tax liability because those funds are no longer on the income statement. So we see here depreciation 200,000. So what this tells us is before depreciation we had EBIT plus depreciation of 750,000. But this 200,000 for depreciation comes out, and that 200,000 comes out and it's not subject to tax liability, only this 750. Now the next part of this income statement is asking for interest expense. Well, we know the firm is 100% equity finance, so if there's 100% equity, that means there's no debt, which means there's no interest expense. So we can put a big zero right there. And that simplifies everything. So that means then EBT is going to be equal to EBIT. Tax is 40%, so what we're saying as well is equal to this amount times our 0.4. So we have to pay 300,000 in tax, and then what's left over is equal to our net income. So our EBT less tax is our net income. Now the next portion of this question is what is our net cash flow, or more importantly, what this is getting at is what is the firm's, think of it another way, is operating cash flow, what we more talk about in class. So what we're saying here is EBIT less tax plus depreciation. So we want to add back in our depreciation. Well, we already know depreciation is 200,000, so it's equal to this 450 plus our 200,000. And again, we refer to that more commonly as operating cash flow. So we have our net income and then our net cash flow. Again, remember this is simply EBIT less tax plus our depreciation. And so we're seeing this amount here. Now, why this net cash flow works here versus operating cash flow, we didn't have any interest expense, okay? If money had actually been spent on interest, this is going to differ then from our operating cash flow. But in this example where it's exclusive of the financing aspect of the firm, we don't see any difference, all right? So net income 450, net cash flow 650. The difference between the two is the depreciation. Why? We perceive our assets as losing 200,000 in value this year. We pull that money out of the income statement. It stays in the bank account, but it's not subject to tax liability.